September will have a rate cut. And the question is, how deep will that rate cut be? And that's where the jobs report and specifically the unemployment numbers are going to come in. Because if the Fed sees some weakness in the labor market, that would give them the incentive to do what we call a jumbo rate cut, a rate cut of 0.5%. And the odds of that, according to the CME's FedWatch tool, are 36% that there will be a rate cut of 0.5%. And that would really move gold. That would be a catalyst that would drive gold to higher pricing.
The gold market attracts buyers, with many investors eager to take long positions, confident that the precious metal will continue its upward trajectory. Analysts point to several reasons for this optimism, suggesting that gold will increase over the long term. One prominent voice in the gold market, analyst Gary Wagner, highlights the recent resilience of gold prices. Wagner notes that traders have been quick to buy on dips, particularly when December futures approach the $2,500 mark. This behavior indicates strong underlying support for gold, driven by several key factors. A primary driver of gold's resilience is the growing expectation that the Federal Reserve will soon cut interest rates. This expectation is fueled by recent economic data, which shows that inflation is continuing to ease. Over the past 3 months, the annualized reading of the PCE index has been well below the Fed's 2% target, providing further evidence that inflation is cooling. Fed Chair Jerome Powell recently signaled the time has come to cut rates. This follows a period of aggressive rate hikes in 2022 and 2023 aimed at combating decades-high inflation. The central bank has kept its policy rate in the 5.25% to 5.50% range since July, but a rate reduction is increasingly likely with inflation easing. Wagner suggests that if the Fed cuts rates by 0.50% in September, gold prices could surge to around $2,560 to $2,580. Potentially nearing or surpassing the recent record-high close. However, he also warns that if the Fed does not cut rates, a scenario he views as unlikely, gold prices could face sharp declines. During the recent trading session on Wednesday, gold initially declined. However, the $2,480 level has proven to be strong support, with the market showing signs of resilience. As the Federal Reserve prepares for its next move and geopolitical tensions persist, there are plenty of reasons to believe that gold could rally shortly. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
The interesting thing that we are seeing in gold is the fact that although gold traded under pressure this morning, and I'm referring to December futures above 2,500, it seems as though every time it's gotten close to that kind of key psychological level, I think the low today was 2506, traders come in and buy the dip. They look at that as an opportunity rather than fading the market and taking it lower. And that to me shows that gold has been resilient. And it's resilient for a couple of reasons. The primary reason is the floodgates have opened up, so to speak, with Powell's comments at Jackson Hole just a few weeks ago, in which he said that it's time for a policy change. So he is signaling that they're going to cut rates. Although he hasn't really talked about a timeline, the inferences by almost across the board in terms of analysts is that September will have a rate cut. And the question is, how deep will that rate cut be? And that's where the jobs report and specifically the unemployment numbers are going to come in, because the Fed sees some weakness in the labor market. That would give them the incentive to do what we call a jumbo rate cut, a rate cut of 0.5%. And the odds of that, according to the CME's FedWatch tool, are 36% that there will be a rate cut of 0.5%. And that would really move gold. That would be a catalyst that would drive gold to higher pricing. I think that for the most part, a 0.25% rate cut is currently baked into current pricing, which means that, and I think that the probability are really, really low that they wouldn't cut rates in September, but if they didn't, that would put gold into a tailspin. I don't think that's going to happen. In fact, I'm certain, at least in my mind, it will not. And the question is whether or not they cut rates by 0.5% because that, for the most part, hasn't been worked into current pricing. And that would provide gold a price boost, tremendous support, and take it, I think, as high as maybe, well, the recent high last week was about 25.60, and we just pulled the chart up, and you can see that right here, these tops that came in. That's the highest record close in history. So when we look at it that way, to get back there and above would be 25.60, 70, 80. We could see numbers going into that area if the Fed cuts rates by 0.5%.
The US dollar USD is trading lower this Wednesday following the release of the JOLTS job openings report, which came in weaker than expected. As a result, the dollar index, DXY, is currently trading at $101.684, down 0.09% on the 4-hour chart. The softer labor market data has added to the dollar's recent downward pressure, with traders closely monitoring key technical levels. The 50-day exponential moving average, EMA, is currently offering support at $101.567, suggesting the potential for a bullish reversal if the price remains above the pivot. However, a break below $101.630 could increase selling pressure, pushing the dollar lower. Analyst Gary Wagner emphasizes the critical nature of these technical levels. He notes that a decisive break below the 100 level on the dollar index could have significant implications. With little support until the 98 level, a price not seen in over 4 years, the dollar is in a precarious position. Such a scenario could ripple through other markets, including commodities like gold, which tend to benefit from a weaker dollar. Let's get back to the interview.
This is the dollar index. It is a longer-term chart in that every candle represents 1 week in trading. We need that to pack this much data in. And as you can see, late last week, we had the dollar index go just around 100.50. And this 100 is key because we haven't seen that price point since July. But if we look at it on a technical basis, we have to go back to really April of 2020, really 2020 is the last time we really saw this become a top here. And the interesting thing about technical analysis, support and resistance is they're part and parcel of the same thing. So here it was a point of resistance. And when it blew that out, and this is really April of 2022, it took it all the way up to really 114 on intraday highs. When it came back down in July of 23, it actually touched almost near 100. And then we've been range bound between 106 and 100. And so we retested that. And last week it kind of popped off of that. And what will be interesting is whether or not the dollar can build some steam and move back up, or if it tests this area, because if we get a hard break, say below 100, on a technical basis, there is no support that really comes in at all till around 98. That was years ago, 4 years ago. So the dollar's in a very precarious position. And of course, a lower dollar benefits gold. Obviously, there's a 100% correlation. So if we get continued dollar weakness, that's another level, another layer that can move gold back near the record highs that we saw last week.
Both the gold and dollar markets are at pivotal points, with potential shifts in Federal Reserve policy and broader economic indicators likely to play significant roles in their future trajectories. As we watch these developments unfold, it's crucial to consider how these factors could impact your investment strategies. What are your thoughts on the current state of the gold and dollar markets? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.